Welcome to the B.F. Anderson Techno Fundamental Report for September 21st. Listen to the market. The market is a discounting mechanism. It sees the future. You want to listen to it. You want to let it come into your brain and absorb. And basically, we all have different brains, as we're all different people. We have to be open-minded. We have to think and use your imagination in a lot of circumstances. But the main thing about listening to the market is that you're going to develop a strategy. Now, in the past, this fellow right here, for 35 years, never had a down month, never had a down quarter, never had a down year. It was all made up. And so what happens with people, they look for strategies, and the reason why he was able to collect so much money was because everybody out there, and this was dealing with the 08 financial crisis. Up until that point, that's when he got in trouble. But the thing about a strategy is you want to stick with your strategy. In other words, we all have different brains. Some of us have growth brains, which is where we're looking for new things. Some of us have value-oriented brains, where we're looking for things that are selling cheaply. Personally, I haven't really found that to be the way to go for me, because in order to find a cheap situation, the company has to be on the ropes and in a difficult position, and you're just speculating that it's going to come out of it. So what happens is that you'll get into a cycle where a certain strategy works and your strategy doesn't. So my point is, there is no strategy out there that works all the time. It's mathematically impossible, because if it worked all the time, then everybody would do it, and then it wouldn't work. So it's kind of like a dog chasing its tail, or you're betting on this horse and you want to switch to this horse, or you're standing in line at the grocery store and you think if you jump to another line, things will be better. So main thing about it is you need to get your brain straight on what is my strategy, and just realize that you're going to go through difficult periods. All stocks are having a difficult period here. Now, as you come out of the bottom of the market, after we've had a substantial drop in 22, started trying to come out of it in 23, and so you do these test buys where you'll put a little bit of money in the market and see if you can make some money. It's a process of elimination where you're looking for, take the 1980s when we were coming out of the bear market of the 70s. One of the first stocks to pop up was Microsoft. So if you bought, let's say you bought 10 stocks, of which one was Microsoft would have been your big winner. In the 70s, this is very similar to the 70s because we had rising interest rates and stagflation, et cetera. And then if you picked up on a company called Walmart, well, that's what made the difference. That's the only way, in my opinion, that you get through this process. You've got to find the next big thing. Now, the other thing, too, is we do believe that the sellers are kind of running out of steam. The market has been pretty much locked in a trading range, pretty much back and forth, which kind of tells us, maybe the sellers are done. Now, you take it a step at a time. You take it a stock at a time. You take it a day at a time. And if you have a stock that is just not working out, the best thing to do is maintain a stop loss and make sure that you exit the position. Now, I did want to mention something called parity, where you get into a situation where the buyers and the sellers have reached parity. So in other words, if you take a period somewhat like this, which is also called a consolidation, in other words, the stock broke out, buyers come in, sellers come in, buyers come in, sellers, but they're basically in parity. So what happens here is, back in this situation, the buyers take over, and there's no longer parity. We consolidate, buyers take over, we go into an uptrend, so forth. So you're looking for a tight pattern in your stock chart, because that means that the buyers and sellers have pretty much reached parity, and you're hoping that the buyers come in and take over. Now, I did want to mention the aggression index. I went back to 1999, where the XLP, that's where it started. If you understand bubbles, and back here in the dot-com bubble, look at what happened here. The reading went off the charts. Then the bubble pops, we come down, and it takes 17 years to get those group of stocks, meaning the NASDAQ, going in an uptrend again. So if you look at 2020, which was one of our better years, we pretty much have got what looks like a little mini bubble that has popped. Now, a lot of that was electric cars and semiconductors and things like that. Hopefully, what's going to happen here is we will then stabilize and get back into an uptrend. That's what we're looking for. Now, I did want to show the advanced decline line. As you can see, lots of more decliners than advancers. This is on the NASDAQ. So you're seeing a really downtrending advanced decline line. This needs to improve. This needs to improve. New lows minus new highs, same story. I mean, we're not making any new highs and we're making too many new lows. It's just not a healthy situation. Again, on the new highs for the S&P, the rule that I use is I want to see 60 a day, kind of like back where we saw back here in 2020. You want to see more new highs. Now, the major culprit here is interest rates. In fact, this morning, it looks like the 10-year Treasury is going over 4.5% for the first time. You can see here, this is the power index. Well, we go back 6 months, 125 trading days, and you can see here that the interest rate on the 5-year Treasury is definitely in an uptrend. Then we're getting very high readings on the power index, which is basically saying that over the last 125 trading days, the yield on the 5-year Treasury has gone up 25%. So interest rates are the culprit here. This is the problem. We've got to see what's important to understand about interest rates. Let me say this. It's not the level of the rate. It's the direction, because they create so much uncertainty because people are going, how much higher are these rates going to go? So you have to realize also that the Federal Reserve does not set free market rates. They set the Fed funds rate. So they're not going to set mortgage rates. They're not going to set, CD rates or certain rates. This is a free market rate. So the market is discounting an uptrend in interest rates that just hasn't stopped yet. The only good news is that the S&P and the NASDAQ continue to be in a primary uptrend where the 200-day has not been violated, and the market continues to make higher highs and then higher lows. However, recently, due to the correction in August and so far in September, we're just not seeing any new highs. Same here for the NASDAQ. Volatility index, kind of interesting. I went back again to 2004, and you look at the volatility index. This is the financial crisis. This is the the financial crisis of '08. You can see what the VIX ended up doing. This is the COVID crisis here. Now, you can see that the VIX has really kind of gotten down into somewhat of a normal area. So, there's not all negative news out there. The VIX is actually, saying it's on a buy signal, actually. On a 3 economic indicators, again, we can see here, as I'm looking at my graph, my indicator right here, the 10-year as of this morning is at 4.48, so roughly 4.5. So this is a little outdated. Interest rates are jumping this morning is what it boils down to. Then we've also got the price of oil going up, which is inflationary, and then we've got the financial stocks acting better. Now, new lows on the New York Stock Exchange. Again, we had 100 new lows the other day, and we continue to have too many new lows. This is not a positive. Money's going to go where it's treated best. In other words, you can see here with interest rates, now this is the 10-year, which is approaching 4.5. Which is up here. The money is going to migrate to where it's treated best. And so interest rates, we're basically putting money in 30-day treasuries, and, that's just where we got to go right now. Transportation index, I just wanted to mention here that it's in a pretty serious downtrend. So all in all, I'm just pointing out that interest rates are the culprit. We'll just have to see what happens. But if you have any questions, please let me know. Thank you.